Welcome traders, David Dubay here of Polaris Trading Group in association with Infinity Futures. This will be our third installment of our weekly review and preview for the upcoming week, April 17th through the 21st. Before we get to the charts, just need to highlight our disclaimers. Polaris Trading Group offers services and products for educational purposes only on a subscription fee basis, and neither PTG or its principals are licensed brokers or advisors. Trading in futures and derivatives on futures is speculative in nature and involves substantial risk of loss. Past performance is not indicative of future results. Alright, so with that, let's just get to our large degree chart here, our profile that we've been using the past few weeks to outline, give us a perspective of the overall action and various swings. Many of you will recall that we've been in the process of building this particular chart out, and as each week goes by, it gets a little bit more obvious where the market is intention on going. So as you can see here, over the past few weeks, we've been talking about this downtrend channel, and we were also referencing the upsloping 50-day moving average, which up until this past week has held on a closing basis, and which has kept the short-term bias, at least contained to the upside. Though we had a bounce up to the 2372 Yell level a week and a half ago, we found resistance at that level, which is the downtrend channel line as well. Last week, many of you, of course, are aware that the geopolitical situation took a more aggressive stand with the Moab bomb being detonated over in Afghanistan, and as a result, again, the market kind of found a little bit jittery, and again, when the market finds, is uncertain or is gets a little nervous, first thing they do is run to the exits, go into more defensive positions, and set it out and reevaluate the situation. But as you'll see in a few minutes, we're going to take a closer look at the underlying action of the marketplace. We can certainly see what the market has done here in the past, but one of the more important questions that I like to seek to answer in the indexes is what is driving the index. Okay, what are the sectors, the groups that make up the index that are driving the index, and that's kind of an important aspect. If you are trading futures and you are trading just single index futures, it is really important to understand what is driving the action, because the big mutual funds, money managers, they're the ones that are investing the millions and billions and trillions of dollars out there. And so it's really important to understand, where that money is flowing. So we'll take a look at it in a moment. But on this particular chart here, we'll see that we have certainly an ABC wave 4 in place now up at the 2372s. And since then, this past week, we've seen 4 declining days. With the important part of this, though, is shifting value. Also, the green area and the high volume node has been stair-stepping down. So that is clearly a negative. And the next thing is the market closed below a rising 50-day moving average for the first time. So that has turned the market a bit more on the defensive. Market closed near its low end of the downtrending channel. Now that not necessarily is going to offer support, but that is a marker. So if we get some sort of a relief bounce into next week, we will be at least looking for the 2350s. Keep that in mind. 2350s has some initial resistance on any bounces. But currently the swing momentum is down, and what I've outlined here on a couple different levels are some targets. 2318s down here. This is about 75% of the past swing from 3 to 4. And then should the market break swing low of 3, the potential target now, if that occurs, brings us all the way down to around the 2303s. So roughly the 2300s as a round number, and the market tends to respond off of round numbers. So that's the bigger picture. Now what we want to do is take a closer look at what was driving, what has been driving the market, and a little bit different perspective for you guys this week to take a look at how some of the other tools and things that I look at from a broader perspective to kind of evaluate overall what the market's been doing. I think you'll find it interesting. Okay, so on the next graphic here, this is an application called stockcharts.com, and it is an application available to the public. They have a free section. They also have a premium section. I've been a member, been using this application now for better part of 15 years. I think it's one of the best applications out there, but there are numerous ones, so feel free to explore stockcharts.com on your own and see if you like anything of it. All right, so again, as I mentioned in the indexes, the S&P 500 particularly that we're looking at, and it could be anything, the NQ, etc., but the indexes are made up of various sectors and industry groups. And it's really important, even though we may trade just the index itself, it's really important to understand what drives the sector, where is the money flowing. And, you know, that, because again, the big institutions, they're the ones who are investing all these, you know, all the public's monies and so forth. So, you know, where their decision making, if they're getting more aggressive, if they're getting defensive, what groups are they rotating into and out of, and that becomes, you know, and again, by having some understanding of this, can give you a read into, you know, what at least has been happening, but it can give you an insight of what also, you know, may unfold as the next week progresses. So this past week. Okay, this particular graphic here shows, this is a graphic of the sector spiders, all right, the ETFs, and all various sectors. So that will be the technology, cyclicals, materials, energy, consumer staples, healthcare, utilities, and financials. And what this is a relative performance chart, meaning that how has each individual sector performed relative to the benchmark S&P 500. So as you can see, this past week, under the zero line here, okay, so you can see technology was down slightly, industrials, again, materials, energy, and of course financials. All right, we'll take a closer look at that shortly. And consumer staples, which is a more defensive sector, as well as healthcare and utilities. So what this particular graphic shows is that the market last week became very defensive. And when the market becomes very defensive, right, again, it's very difficult for the price of the index to actually rise. It's more likely to decline. Okay, so that is part of that particular graphic. I'm going to show you another one, which is a very interesting chart as well. Okay, so the next part of the stock charts application is what's called the relative rotation graph. Now, in the prior graph that I just showed you, the bar chart, that is a static snapshot at a singular point in time at week's end. What this particular chart shows it actually shows movement over time of the index or the particular groups that are in question. So again, we're taking the same look at the sectors, the technology sector, the XLKs, the healthcare, utilities, consumer discretion, staples, financials, energy, etc. But in this display, it shows where have they been over the past 10 weeks, where they currently are now, and what part of the, you know, are they improving, are they weakening, are they leading, are they lagging? Okay, so there's four blocks in here, and as you can see, particularly the financials, the XLFs, okay, which is a proxy for all the banking system. All right, now you can see that it had been several weeks back, had been in the leading group, and again, that made sense because interest rates had risen. All right, and again, banks and you know, financials tend to do better. Insurance companies tend to do better when the interest rates are up. But this past week or two or three, the market has been getting again much more defensive, and interest rates have actually started to come down a bit. We've had the bonds rallying again. There's an inverse relationship there as well. So the financials have been weakening. All right, that can turn and they can re-strengthen, but generally at right now at the end of this past week, they're weakening. Energies have been lagging. All right, there should be no surprise there. Over here, you can see the XL case. Now, again, that's the proxy for the technology group, and we all know the technology group has been the strongest, actually, sector or group in the marketplace. So that still is the case, although this past week we've seen a pullback in the technology group. It is still, on a relative basis, leading. What is interesting, though, is that the healthcare, utilities, and consumer consumer staples, all right, have been improving. Now, again, when they improve, those three, when they improve, that means that the market is getting much more defensive. Okay, and so you can see over the past several weeks here, these three groups have been actually in the improving block, and they have been moving closer and closer to the leading block. So again, it's really important to understand, the direction that the groups are heading. So this particular graphic offers a very interesting, unique view of this, and we can make some inferences that the market not only in the past has become defensive, but may continue to be defensive unless we see some change in the underlying dynamics of consumer discretionaries. The industrials, right now the industrials over here are in the in the weakening sector. Now again, industrials, think about transportation stocks, all right, things that drive the economy, all right, and again they're weakening as well. So we'll take a weekly view of this, but as of this past week, the summary is that the market has become much more defensive. All right, so since we did a quick review of where the market has been this past week, let's take a preview of what may unfold for us next week. Again, one of the first things I always look towards is the weekly calendar. All right, what's on tap, what's important, highlight some key releases, housing starts. Again, always a economic marker. All right, so that's on Tuesday. We have jobless claims out on Thursday, and the PMI and existing home sales on Friday. Of course, Wednesday is our EIA petroleum status report, all right, which we keep an eye out on a daily, weekly basis as well. So not huge in terms of economic releases. One thing to note: corporate earnings releases will be more plentiful now. After the holiday, all right, so we're getting into the meat of the earnings season, so we'll see if that factors into what may unfold this week. Okay, the next chart I want to take a look at is the weekly profile, the past 2 weeks. So I've combined the profile here into two single profiles, but each represents a week, all right, and the important areas that I want to focus on, as always, are the point of control, which is the fat red line, as well as the upper and lower value areas. All right, so again, this past week, you can see we got a shift in the entire value area down. That's the gold area. Okay, so one of the concepts of profile is the shifting of value. All right, and that makes an important statement, and the reason for that is simply that in order to shift value, the entire high-low of the value zone takes in a tremendous amount of collective energy. Thinking of that 70% of the entire volume that's traded on a profile period happens within that value area high-low. So an entire shift of value becomes like a seismic shift in the market. Okay, so make note of that. So as we come into this week, you can see the price closed very weak in the profile at 2750 area. This is on a day session only, regular trading hours basis, and The lower value area from last week is at around approximately the 2334s, high volume at about 42s, the node, and the upper value around the 5152s. And again, that is very close to the prior week's point of control, right? So that 52, 53 area, if tested sometime this week, will come into play and will be a very big test. First thing that needs to happen, though, for the bullish case that I see is clearly stem any additional selling. Now, there hasn't been anything over this weekend that has escalated in terms of what happened this past week relation to the geopolitical scene. But, again, that can change at a moment's notice. But if there isn't anything, more negative on the horizon, we may get kind of a relief rally back up into the prior week's range. First thing I'd want to note is to see how the market reacts around the 2334s and then back around the 43s in that area, the high volume node. Okay, so that'll be the first test to see what happens there. Should the market continue to kind of work its way through that area and without any real resistance, all right, then the next real level of resistance will be anywhere from, again, the 48 level up to those 53s. Again, we're just kind of backtracking to where some key levels were, all right, and again, we don't have to make any predictions, but we just want to know where those key levels occurred, where the market changed character. And when the market retraces back to those levels, typically there is some level of response. So keep an eye out onto those levels into next week. And let's see, one last thing we want to take a look at is the upcoming cycle day. Okay, so the next cycle day here is on Monday will be cycle day 2, right, in the 3-day cycle period. Cycle day 1's low is down here on the 24-hour basis, is down here at the 24s, and it's around the 34s on the cash basis. So typically when the market closes weak in its range on cycle day 1, which was this past Thursday, right? Again, it was a shortened week last week because of the holiday. The market typically follows through. Meaning that closing low in the range, all right, offers some potential continuation move, all right, of that week period on the session prior. Should the market continue lower, okay, pay close attention to the cycle range low at 22s, all right, for a potential response and a reversal. If that holds, then we could look for a nice bounce back up that would bring us back probably near the 32-34 area. Again, there's a lot of activity that took place there for that. Should the market continue, continue really weak, all right, the next really kind of key levels to look for are the violation levels for cycle day 2, and again, that's down near the 1312s. And again, same type of reaction. I would be looking for some sort of a reaction off of that to counter that extending move. All right, so that's one scenario. The alternate scenario is there is no further weakness. Market opens strong up back into Thursday's range. And again, I would be looking for some initial resistance should that occur back up here near the 38s. In 38, 40, 42 area, all right? And again, there's a lot of congestion around that area, and the market needs to test and see if it can, if there's a counter response to that, okay? So cycle day 2 typically is a kind of a neutral backing and fill day, and if the market can find a secure low, then look for the market to attempt some sort of a rally. Okay, and that will conclude this week's review and preview for the upcoming week. And we'd love to, for those of you that have not taken a free trial with us as of late, and you're viewing these videos for the first time, please come in, take a free trial on compliment of us, and 14 days. Just visit the website on the display, sign up for a free trial, and come take a closer look at what we do on a daily basis. And again, for any additional information, would you like to contact me, feel free to reach out to me, david@polarisTradingGroup.com. Visit the website, PolarisTradingGroup.com, and be sure to contact your Infinity representative or Patrick Zielbauer for any additional information regarding the video. All right, thanks very much, everybody. We'll see everybody next week in our trading room, and good trading.